You send $200 across a border. The global average fee is 6.36%. That is $12.72 gone before the money arrives. Then you wait. Maybe hours, maybe days. Global finance moves trillions. Your transfer still gets treated like physical mail. Behind that transfer sits SWIFT. It connects more than 11,500 institutions across more than 200 countries and territories. In 2024, the network handled 13.4 billion messages. That was 53.3 million every day, 12% more than the previous year. SWIFT says the value transmitted across its network equals the entire world's annual economic output roughly every 3 days. This is not a payment app. It is the command language of global banking, and almost every major bank speaks it. Here is the first twist. SWIFT does not move your money. It moves instructions. Think of a secure financial WhatsApp. Bank A sends Bank B a standardized message. Debit this account. Credit that account. Confirm the identity. Include the currency. Include the purpose. The actual money moves through accounts banks hold with each other. These are correspondent accounts. The message can move in seconds. The balance sheet follows a separate route. That separation created global reach. It also created layers, blind spots, and fees. Before SWIFT, banks relied on telex. Messages were slow, formats were inconsistent, security depended on manual checks and test keys. In 1973, 239 banks from 15 countries formed a cooperative. The goal was simple: one network, one language, less chaos. SWIFT launched operations in 1977. Standardization worked, more banks joined, more routes opened. Every new member made the network more useful. The useful network became the default. The default became infrastructure. Now replacing it means replacing thousands of integrations, compliance systems, operating procedures, and trusted relationships at once. Send $1,000 from a small American bank to a supplier in Vietnam. Your bank may not hold Vietnamese dong. It may not have a direct relationship with the receiving bank. So the payment enters a chain. Your bank sends a SWIFT instruction to a larger correspondent bank. That bank converts dollars. Another correspondent may handle the regional route. The final bank receives the instruction. Each institution checks sanctions. Each checks fraud. Each checks names, account numbers, and payment purpose. One mismatch can stop the chain. One closed local settlement window can add a day. The customer sees one transfer. The system sees 4 banks, 3 ledgers, 2 currencies, and a stack of risk controls. Now count the tolls. Your bank charges an outgoing wire fee, often $25 to $50. A correspondent bank can deduct another fee. The receiving bank may charge again. Foreign exchange adds a spread. A displayed rate can be 1, 2, or 3% worse than the wholesale market. On a $10,000 transfer, a 2% currency spread costs $200. The wire fee is visible. The exchange rate markup is quieter. Intermediary deductions can be unknown until delivery. This is why the amount sent and the amount received can be different. The chain prices complexity. The customer pays for every link. The old headline says, SWIFT takes 3 to 5 days. That is now incomplete. SWIFT reports that 75% of payments reach the beneficiary bank within 10 minutes. More than 90% arrive at that bank within 1 hour. The network is fast. The customer experience can still be slow. SWIFT says the in-flight journey is less than 20% of total end-to-end time. The final credit stage creates more than 80% of the delay. Funds hit the destination bank. Then local cutoffs, weekends, manual reviews, compliance queues, and legacy software take over. Fast message, slow institution. So why not switch? Because global payments are a network problem. SWIFT offers more than 40,000 possible payment routes. 86% of messages are direct or use only one intermediary. Its network reported 99.9999% uptime in 2024. Banks trust the format. Regulators recognize the controls. Compliance teams know the workflow. Software vendors build around the standard. Arrival must deliver global reach, extreme uptime, legal certainty, cyber defense, identity, message standards, dispute handling, and liquidity connections. All at once. A cheaper message is easy. A trusted replacement for global coordination is not. SWIFT is a Belgian cooperative. It is owned by financial institutions. It is not a profit-maximizing Silicon Valley company, but neutral infrastructure can become geopolitical leverage. Disconnect a bank from SWIFT and international business becomes dramatically harder. Messages must find slower, smaller, or bilateral routes. That is why SWIFT access became a sanctions weapon against Iranian banks and selected Russian banks. The network did not seize the money. It restricted the dominant communication channel. This exposed a hard truth. A system built for efficiency can become a border checkpoint for economic power. Domestic money already moves differently. Brazil's Pix runs 24 hours a day. India's UPI handles real-time payments at enormous scale. Europe's instant payment rules push euro transfers towards seconds, not days. These systems settle inside one legal and currency zone. Cross-border payments must bridge different rules, currencies, time zones, and risk systems. That is harder. But the comparison is brutal. Domestic payment, seconds. International wire, unpredictable. Domestic fee, often near zero. Cross-border retail cost, 6.36% on average. Customers do not care which institution caused the delay. They see one broken product. Fintechs attack the front end. Wise pools money locally and avoids moving every customer payment through a full correspondent chain. Stablecoins attack settlement hours. A dollar token can move 24/7. Central banks are testing shared ledgers and linked instant payment systems. BIS experiments have completed cross-border transfers and foreign exchange in seconds, not days. Some prototypes estimated cost reductions of up to half. But speed is only one test. The challenger must also handle sanctions, fraud, mistaken payments, liquidity, privacy, finality, and regulation. Moving a token is easy. Replacing institutional trust is expensive. SWIFT knows the threat. It launched end-to-end tracking through global payments innovation. It pushed banks toward ISO 2022, a richer data standard. Better data means fewer manual repairs. It is developing rules for faster retail transfers. It is also building shared ledger infrastructure for tokenized value. The strategy is clear. Do not defend the old message pipe. Become the connector between bank money, instant payment systems, and digital assets. SWIFT survived Telex by becoming the standard. Now it wants to survive tokens by becoming the interoperability layer. SWIFT is not the only reason international transfers cost too much. It may not even be the slowest link. The network moves most messages quickly. The real machine is bigger. Correspondent banks, foreign exchange desks, compliance rules, local payment systems, and outdated bank software. But SWIFT sits at the center. Its scale protects it. Its standard gives it power. And its dominance lets a fragmented system keep feeling inevitable. The monopoly is not simply a company. It is coordination itself. The next time a transfer loses $50 and disappears for 2 days, remember this. The message probably arrived first. Your money got trapped in the machinery around it. Global finance is not waiting for faster technology. That technology already exists. It is waiting for thousands of institutions to surrender the tolls, habits, and control built into the old route. This is macro flow. Follow the channel. We expose the systems hiding behind your money.